What if China's biggest resource problem isn't shortage, but dependence? Because behind all the headlines about trade, tariffs, and geopolitics, there's a quieter struggle happening underneath the global economy, a fight over iron ore, lithium, rare earths, and the supply chains that power steel mills, electric vehicles, batteries, and modern industry. And China is moving fast. A recent think tank estimate said Chinese firms have invested more than $120 billion in overseas mining and upstream processing since 2023. At the same time, Australia remains central to China's raw material supply, especially in iron ore, which is still the bedrock of the relationship. In fact, Australia's own export finance agency says iron ore made up almost 60% of Australian goods exports to China over the year to May 2024. This is not a shooting war, but it is a high-stakes contest over leverage, supply security, and who gets to shape the next industrial era. Start with iron ore because this is where the relationship is still brutally simple. China is the world's largest iron ore buyer. Reuters reported that China imported about 1.24 billion metric tons of iron ore in 2024, a record high for the second straight year. Another Reuters analysis noted that China buys about 75% of global seaborne iron ore. So even though China wants more control over its supply chains, the reality is that it still needs enormous volumes of ore to feed its steel sector. And here's the part that makes this strategic. China's steel demand has been under pressure from a weak property sector, yet iron ore imports stayed strong because low prices encouraged stockpiling and because blast furnace steelmakers stayed competitive. That means the relationship with Australia hasn't disappeared. It has remained essential, even while Beijing tries to reduce its exposure. So the real story is not China has escaped Australia. It's that China is still trying to escape while remaining deeply tied to the system it wants more control over. So what does China do when dependence starts to look dangerous? It builds alternatives. The clearest example is Simandou in Guinea, one of the biggest untapped high-grade iron ore projects in the world. Reuters reported that the project is expected to ramp toward 120 million metric tons per year, and that at full scale, it could meet roughly 10% of China's annual seaborne iron ore imports. In January 2026, China received its first Simandou shipment, a symbolic moment in Beijing's long effort to diversify away from over-reliance on Australia and Brazil. But Simandou does not mean Australia suddenly loses, not even close. The same Reuters reporting makes clear that Australia still sits at the center of the seaborne iron ore trade, and Australia's government is watching these shifts because they matter directly to public finances. In February 2026, Reuters reported that a $10 move in the iron ore price would change Australian tax receipts by about $500 million in the 2025-26 financial year. That tells you how much leverage and how much vulnerability still exists on both sides. Now widen the lens, because the future is not only about steel, it's about critical minerals. Australia remains a heavyweight in this space. According to the US, Geological Survey Australia produced about 92,000 tons of lithium in 2025, making it the world's largest lithium miner. With world output around 290,000 tons, that means Australia accounted for roughly 1/3 of global lithium mine production last year. The Parliament of Australia also noted that in 2023, Australia produced 49% of the world's lithium, showing just how dominant it has been in recent years, even as new supply has grown elsewhere. And Australia is not treating this as just another export story. Its Critical Minerals Strategy 2023-2030 says the country wants to build diverse, resilient, and sustainable supply chains, strengthen international partnerships, and grow domestic processing rather than simply shipping raw material offshore. That matters because raw rock is one thing. Refining, chemicals, magnet materials, and batteries are where strategic power really starts to multiply. But here's the nuance a lot of videos miss. Australia has mineral strength, yet it does not dominate every part of the value chain. The Parliament of Australia says plainly that while the country is a global leader in mining and exporting raw materials, it does not yet have a well-developed capability for processing and value adding across the board. That gap matters because China's long game has not been just to buy minerals. It has been to build control across mining, refining, and manufacturing. Reuters, citing IEA data, reported that China controls about 87% of global rare earth refining capacity. That is why Western governments keep talking about resilient supply chains instead of just more mines. That also explains why Australia has become more selective about foreign investment in sensitive mineral assets. In 2023, Reuters reported that Canberra blocked a Chinese-linked investor from increasing its stake in rare earth producer Northern Minerals on national interest grounds. So this is not simply a story of open trade anymore. It is also a story of screening, strategic caution, and governments deciding that some mineral assets are too important to leave to normal market logic. Now, let's bring this down from geopolitics to economics. When people hear resource race, they imagine shortages and soaring prices. But the real market is messier. In lithium, for example, prices collapsed because supply outran demand expectations. Reuters reported in 2024 that Australia, which supplies a little less than half the world's lithium by that measure, was expected to bear the brunt of production cuts because its mines were generally higher cost and less vertically integrated than some rivals. At the same time, USGS data show how brutal the price collapse was. The annual average US battery-grade lithium carbonate price fell 66% in 2024 from the previous year. That's why this story is bigger than China wins or Australia wins. Sometimes a scramble for resource security pushes prices up. Sometimes it floods the market and crushes producers. Sometimes governments want more domestic processing, but investors still want the cheapest route. And sometimes the same country can look powerful in one mineral and exposed in another. That is exactly why this contest is so unstable, because it is happening across iron ore, lithium, rare earths, nickel, copper, and battery materials all at once. The bigger danger is not just who owns the rocks in the ground. It's whether the world can build enough diversified supply before demand accelerates again. The IEA has warned that total mineral demand from clean energy technologies could double by 2040 under its stated policy scenario and quadruple by 2040 under its sustainable development scenario. That is why countries are suddenly talking about recycling, alternative chemistries, strategic reserves, and allied supply chains. The problem is that building a mine takes years. Building a refinery takes years. Building a whole industrial ecosystem takes even longer. And when supply chains are concentrated, politics gets sharper. Reuters noted that the world's push to develop independent critical mineral supplies became more urgent after China imposed export controls on gallium and germanium, raising concern that Beijing could use processing dominance as geopolitical leverage. So when people say this is only about trade, that's outdated. This is now about industrial strategy, national security, and who gets squeezed first when the next bottleneck hits. So who actually has the advantage right now? China has scale, financing power, refining depth, and a clear strategy to diversify supply. Simandou proves Beijing is willing to spend years building alternatives to reduce dependence on Australian ore. Chinese firms have also kept pushing into overseas mining and upstream processing across Africa, Latin America, and Asia. But Australia still has what every industrial power wants: vast reserves, established mining expertise, reliable export infrastructure, and a central position in iron ore and lithium. It is also trying to convert geological advantage into political and industrial leverage through partnerships with the United States, Canada, the UK, Japan, India, Germany, and the EU. So the truth is more complicated than a clean victory for either side. China is trying to reduce dependence. Australia is trying to turn resource strength into long-term strategic influence. Neither side is fully where it wants to be yet. So here's the real question. If China keeps building new supply through projects like Simandou, and Australia keeps moving up the chain from mining into critical mineral strategy and allied partnerships, does this become a more balanced market or a more fragmented world? Because this isn't just about China and Australia anymore. It's about the future price of steel, batteries, EVs, energy systems, and the raw materials underneath modern life. So who do you think has the stronger hand now? China's supply chain strategy or Australia's resource leverage? And when this competition intensifies, where does that leave the rest of us?